Imagine waking up to news that every Chinese company listed in the US has just been kicked off the stock exchange. That's over 250 companies, including giants like Alibaba, JD.com, Pinduoduo, and Baidu, gone. Combined, these companies hold a market capitalization of over $1.1 trillion on US exchanges. So what happens next? Well, a financial earthquake. US investors, both institutional and retail, are deeply exposed. Over $775 billion is currently invested in Chinese ADRs listed in the US pension funds, university endowments, insurance firms, and even your 401k may be holding shares in these companies, often through ETFs or mutual funds like Vanguard or BlackRock. Retail investors alone account for an estimated $150 billion of that total. These aren't just numbers on a screen. These are retirement plans, tuition savings, and future home down payments. So how could this happen? Enter President Trump, or any future administration. Under laws like the Holding Foreign Companies Accountable Act, the US already requires foreign companies to comply with US audit inspections. If China refuses, as it has for years, a full delisting could be triggered by executive action, citing national security, data privacy, or economic retaliation grounds. We've seen precedent before. Luckin Coffee, once hailed as the Starbucks of China, was delisted after an accounting scandal. More recently, Huawei was banned from US supply chains entirely. The legal and political path is there. All it needs is the will. If these companies are delisted, they can't trade on Nasdaq or NYSE. So what happens to the shares? In theory, they can convert to shares on the Hong Kong or Shanghai exchanges, if investors act fast and if the legal conversion is smooth. But who's buying? Without US market access and investor confidence, demand would plummet. Prices would crash. We're talking a potential free fall in valuation. If those stocks tank, American 401ks and pension portfolios would take a direct hit. Many state pension funds, like CalPERS and sovereign wealth funds, have exposure to Chinese tech and growth plays. One estimate suggests a forced delisting could wipe out $300 to $500 billion in equity value almost overnight. It's not just investor losses. Wall Street banks, legal firms, auditors, and compliance teams make billions supporting these companies, handling IPOs, financial filings, and cross-border transactions. Delisting could eliminate tens of thousands of high-paying finance jobs, especially in New York, San Francisco, and Hong Kong. Some firms, like Goldman Sachs and Morgan Stanley, could see hundreds of millions in lost revenue annually. Delisting doesn't just hit stocks, it hits asset-backed portfolios. Insurance companies that hold Chinese equities as part of their reserves, they'll see asset bases shrink. Pension fund liabilities will rise as assets drop, forcing tough decisions, raise premiums, cut benefits, delay retirement payouts. Globally, the message is loud and clear. US capital markets are no longer safe havens for foreign companies. This could push China to de-dollarize faster, accelerate the rise of Hong Kong or Singapore as regional financial hubs, and shift trillions in capital eastward. American investors? They'd lose access to the world's second largest economy. The ripple effects would stretch from Wall Street to Main Street to retirement homes. The threat of forced delisting is more than a headline. It's a ticking financial time bomb. Are your investments prepared? Don't forget to like, subscribe, and drop a comment. Should Chinese companies be allowed to stay listed on US exchanges? Or is it time to pull the plug?